What's up, everybody? Thank you for tuning in for another episode of Rooted in Richmond. I'm Cody Adams, and today I'm joined by my good buddy here, Jackson Brower. He's my go-to mortgage loan officer here in Richmond, Virginia. Today we're going to be pulling back the curtain on the do's and don'ts of buying a house and the things you also need to do before speaking to a realtor and or mortgage loan officer. Jackson, you ready to get into it a little bit?
Absolutely. Thanks so much for having me, Cody.
Dude, no problem, man. I'm glad you're here, and thank you so much for joining me today. I know you're a busy individual here. So I kind of want to just jump into our first question here. What are some of the financial blind spots you see for buyers when they go to you to start buying a home?
So I think a lot of people get their information from the internet before they talk to professionals. You know, sites like Zillow and Realtor.com, I think it's great because you can look at houses. One thing that I think is a little bit misleading about it is if you look at the estimated monthly payment, that's generally based off of 720 credit score and 20% down. Most of the first-time home buyers that I work with, they don't put 20% down, but they think that's going to be their payment because that's what they see online, right? You can actually, go to a mortgage calculator and, fiddle around with what you'd actually want to put down. Another thing is preparing for closing costs. I think people generally are aware of a down payment, but when you buy a home, you're probably going to pay around $10,000 to $16,000 in closing costs. Now, you can negotiate for the seller to cover those things for you. Just depends on how competitive of a situation it's in. But you need a budget for things other than the down payment on the property. So I would say those are the two biggest blind spots, that payment that you see online, only if you're putting 20% down, and there's more cost than just your down payment.
And so how accurate do you think those mortgage calculators are on the Zillow, Realtor, like all those sites? Are they accurate? So everyone does them, they do.
That is an awesome question. And a question that I get a lot when people call me is, hey, Jackson, what's your interest rate? The real question is, what's your interest rate? It's based off of your credit, your down payment, the property type that you're looking at, and whether or not you're self-employed, your income. There's like 13 different factors that go into determining your interest rate and also the loan product itself. So that interest rate online, that's like what the average 30-year fixed conventional rate is. So it's accurate based off of the rate that they provide, but is that rate going to be the same rate as yours? Probably not.
I feel like there's always like a point difference or like a big gap between what you, not necessarily, but what you see on those sites or like other mortgage loan officers, or even you would quote somebody. So people might be thrown off to what they think they could get this house for once they talk to you versus what you tell them they can actually get this mortgage rate for this house they see.
I don't want to put another lender on blast. If you DM me, I'll tell you who it is. But there's a really popular mortgage company that advertises a super low rate, but in very fine print, it's like, this is 2 points. And for those of you who don't know, a point is paying 1% of the loan amount to lower your rate. Generally, it'll lower the rate by about, 0.25%. So they're advertising, let's say, a 5.5% rate, but you might be paying $10,000 to get that interest rate.
So it's like, we didn't really save that much money, you know what I mean, in the long run. So let's backtrack a little bit. You mentioned credit scores. Now, everyone loves to talk about this magical 6-digit number.
3-digit number.
I don't know where my brain was going with that. Sorry, 6-digit, what am I talking about? 3-digit number, gosh. So basically, when someone comes to you, and I hear it all the time, I need to get my credit score higher. Credit score is this, I can't afford it now, blah, blah, blah. I want to wait till it's like a 750, 780, whatever it is. Realistically, what kind of credit score does someone need to buy a house?
Well, the good news is you don't need a 6-digit credit score. You don't need a, what would that be, $100,000?
Yeah, what time is it? Geez, it's been a long day.
So the average credit score in the United States is about a 680. Anything in the 700s is really good. You can qualify with a score above 580 with a 3.5% down payment on FHA, and actually even lower with a 10% down payment. What I generally recommend to have the best chance of getting an approval through automated underwriting software is a 620 or higher.
The 620. So, but in cases, people have been approved for homes in lower credit score than that. You want to kind of go into that a little bit? Because I think we've had helped some buyers in the past that have had a little bit lower credit scores like that, and they've gotten a home.
So generally speaking, if you have a lower credit score, like lower than 620, you might have to do something called a manual underwrite. That's where the underwriter looks closely at, your rental history, your employment history. They peel back the curtain a little bit more, and it's generally a little bit tougher to approve it. So it's not impossible, but you need strong compensating factors to make up for it, right? So if your credit's a little bit, on the lower side, you might need more money down, or you might need a lower debt to income. It's kind of like a three-legged stool, credit, debt to income, and then capacity, which is also your down payment.
Sure.
If one of those legs is a little bit weaker, the other two need to be stronger to make up for it.
Now, something that we've briefly touched on is talk about how beneficial it is for people to help their kids buy a house in years to come, putting their kids, as a authorized user on a credit card to help them build their credit so their kids, this is like a hack no one really knows. So do you want to talk a little bit about more?
Sure. So getting added as an authorized user is one of the quickest ways to get a credit score and also to boost a credit score. Let's say I've never had credit in my life. If I go out and get my own credit card, it would take around 6 months for my credit score to populate. Whereas if I know someone who has a score in the 700s, they add me as an authorized user, which is just basically permission to use the card. I don't even need a copy of the card.
Yeah.
But just piggybacking off of their credit score, you can get a score in 30 days that's typically in the 700s. It's also one of the fastest ways to boost your score if you have a lower score, and it doesn't bring the other person down.
So just me thinking about this for a second, just like for future potential deals we do together. So for someone that does something like that, we always say, oh, you might need a cosigner. Is that kind of the same route as adding them as an authorized user? Is that a better route actually for somebody?
Okay, so a cosigner generally is going to help out if you need more income to qualify. If a cosigner has better credit than you, it actually doesn't matter, because for the mortgage process, we're going to take the lower of the two scores anyways.
Gotcha.
Right?
Okay.
So if your issue is credit, authorized user is the way to go. If your issue is income, cosigner is the way to go.
Okay, I got you. All right, so let's break this out a little bit. So we talked about the questions we need to ask you. We talked about a little bit about the credit score. Let's talk about the pre-approval versus the pre-qualification letter. After you got all their information and whatnot, let's talk about, they're the same thing, but they're actually very opposite. So talk a little bit about that.
So a pre-qualification is when you've entered your information, but nothing's been verified. You put in your income, you put in your savings, and then you get a letter stating, hey, based off of this, you're good to go. Interesting to me, back before 2008, you could actually just get fully approved off of this. And what happened because of that?
The Big Short movie, that's what happened.
People couldn't afford their mortgages and real estate collapsed. There's a lot of other things that, were going on, but really it was people were getting homes that it probably wasn't in, their best interest too, right? So a pre-approval is not only are you telling us these things, we're verifying it. We're looking at your pay stubs. We're looking at your bank statements. And going a little bit deeper, because, you could be making what you put on there, but if you currently live in New York and you're moving to Virginia and your job is based in New York, can't use that income, right? So be really hesitant if someone says, all right, you're good to go, shop for homes, and they haven't looked at your bank statements and pay stubs, because you want your pre-approval, you want it to be a promise and not just a piece of paper.
Yeah. So we kind of talked about the hidden things, like looking at Zillow. We talked about a little bit of the pre-approval, pre-qual, credit score. So the number one thing, especially in today's market, affordability. And everyone has a different, I guess you could say, idea of what is affordable to them. When you talk to a buyer, when they say, oh, I need something affordable, are you technically looking at, their maxed out pre-approval number, or are you kind of basing it off of, okay, you're giving me this much you want to pay, this is the number you should go for? Kind of go into what affordability means to you a little bit.
So one of the biggest things that I focus on when I help clients through this process is getting them a monthly payment that they can make comfortably, but still save money on top of it, still invest on top of it. The average debt to income ratio in the United States is about 43%. You can generally qualify for a home if you make twice as much as you spend, but your max qualification and what you can actually afford might be two different numbers. We provide guidance based off of national averages, but you'll know more about your household than I would. Now, the other thing that I would say about affordability is you need to ask yourself, can you afford not to do this, or can I afford to wait? What do I mean by that? Is it going to get any easier to purchase a home a year or two from now than it is right now? You know, maybe for some people the answer is yes. Maybe they can really tighten up their budget, save more money. They have opportunities to advance their income. But the other thing that's going to happen is homes are going to go up in value. The average net worth of a homeowner is 40 times higher than someone who rents.
Wow.
So I generally would advise that if you have the ability to purchase a home and you're not gonna, struggle with that monthly payment, and you can get a home that you like, I think it's a great option. And time again, real estate has proven to increase people's wealth.
I guess the simplest thing to say is, if it works for you and the time is correct, do it. You know what I mean? Awesome.
Waiting's not a strategy.
Yeah, for sure it's not. After the buyer closed on the house, what are some of the potential reoccurring fees that can come up with your mortgage that not a lot of people talk about, I feel like?
Sure. So, your mortgage payment, your principal and interest is always going to remain the same. If you have a fixed mortgage, if you have an adjustable rate mortgage, it could change. Your insurance and your property taxes and your HOA, if you have one, are likely going to change over time. Now, the good news is, if your property taxes are changing, it means that your home has gained value, right? But you need to prepare that even though your principal and interest is fixed, these other items are going to change. You need to know what your payment looks like, but you also, need to have some savings in case emergencies happen.
And something really funny just because I'm in real estate, I do this all the time. You do this all the time as well. But a lot of people, like when we close, and I remember I'm sitting at Atlantic Coast Settlement, and they're always saying, your taxes are taken out with your monthly payment and put into an escrow. And I've actually had people call me, say, hey, I just got a tax bill. I thought it was taken out of my mortgage insurance. And I've had people saying, I'm about to pay this, but I wanted to call you really fast. I'm like, no, it's just, they're sending it to you, shred it up, take it away. It blows my mind that not a lot of people realize that. But a lot of these people are first-time home buyers that never had it. So I think this is great to kind of just talk a little bit about.
Sure. So the reason why a county is going to send you a tax bill is twofold. One, to let them know what you owe. Now, if you escrow taxes and insurance, that means that as you make your mortgage payment, you're paying your taxes as well. It's not a bad idea to contact your mortgage servicer to make sure that the bill got paid. But you got to keep these bills and don't shred them up, because come tax time, you actually get to write off 100% of your property taxes as long as it's below, it's either $10,000 or $17,000. Most people around here, they're not paying that much on property taxes. One thing that happened with my own home though, Cody, I bought new construction. The taxes hadn't yet been assessed on the home before I set up the escrow account. They sent me the bill and I'm like, well, shouldn't my mortgage servicer take care of it? Since it wasn't assessed already, the mortgage servicer hadn't factored that in. So I had to pay it out of pocket, even though I had escrowed. Now I got a check back in the mail later on. But contact your mortgage servicer to find out if the taxes have been paid. Don't just throw that bill away.
So that's kind of like a good branch way into our next segment. Doing a mortgage with an older home, one that's already been sold and bought multiple times, and then doing a mortgage with a new construction home. Do you want to talk a little bit about, do they go hand in hand? Are they a little bit different? You just kind of broke that a little bit for us there, but is there anything else that's a little bit different in that process?
Sure. So the new construction can fall into a couple of different categories. You can either, build the home custom. You're the one who's financing the construction, and then you close with a permanent mortgage at the end. Or the builder might have a line of credit where they're the ones who are financing it. If the builder's the one that's paying for the construction, it's not too different than buying a resale. Other than the builder's probably going to give you $10,000 or $20,000 in closing costs.
Which is nice. Super nice.
But if you're going to do a custom home, or you want to buy land and build something on it, your interest rate is going to be a little bit higher, and that's because we're lending on an asset that does not yet exist. Credit score qualifications are going to be higher, and you're generally going to need to put a larger down payment. So that's the main ways that new construction can differ from buying a resale, at least on the mortgage side. But I'd be interested, like on the real estate side of things, what do you think the biggest differences are?
For me, one, and this is going to be very honest, so it's great to work, because I work with you all the time. You've helped hundreds of buyers in Richmond, Virginia, but you also helped pretty much all my buyers in the last 3-4 years here, right? So to me, every mortgage loan officer does the process a different way. You know, I know your process. I know the things are going to get done. I know that you're going to answer any questions. If I'm working with another lender, I don't know their process because this is the first time I'm working with them. So they handle it all a separate way. So for me, I know how you operate. I know what you need it when you need it. I don't know that on the other side. So it kind of puts me in a kind of a, oh my gosh, am I getting everything to her that she actually needs? You know, you have Jennifer, I believe it is your assistant. She emails me, hounds me and everything like that too. But I just think working with you versus working with another loan officer, especially just with new construction, I don't see too much difference. But to me, just working with you through the process is always just so much smoother because I know how you're going to operate. I know when you need things. It just, you know, hands down, that's the only thing different, really.
Process is extremely important and experience is too. I see a lot of home buyers make a mistake of going with, you know, someone that they might be a family member.
Yeah.
They might know them. They might have been in the business for a long time. But the time that you're in the business doesn't really matter that much. It's about your experience.
Yeah.
Someone that's done this hundreds of times, it's generally not by luck. So vetting who you're going to work with up front is really important. Look at their Google reviews.
Yeah.
You know, you want to make sure that they have a really good reputation. That's one thing, you know, if we went back to that blind spot, I'd bring that up. I'd bring up vetting your professional and not just choosing someone because you like them. You should like them.
Yeah, of course.
But you got to trust them as well.
Of course. And like just kind of saying the topic on you for a second, so everyone out there that is watching this knows a little bit more about you. What do you think you bring to the table versus another lender in this Richmond market?
Experience. Going through this hundreds of times, I know what to look out for. And I haven't had a loan denied by an underwriter.
Awesome.
And that happens. People come to me where they're under contract with a different lender and during the process they get turned down. That's a heartbreak we never want someone to have happen to them. Speed. I'm available on the weekends as well. 90% of real estate transactions ratify after 5 o'clock or during the weekend. If you're working with a bank, you're not going to get an update from someone at a bank after 5 o'clock or, you know, on a Saturday or on a Sunday. And it sounds cliche, maybe it is. I really care about people. Like I really love people. And I'm a big believer in me helping them get this home is going to increase their wealth.
100%.
Like I am obsessed with helping people increase their net worth. There's a lot of emotional benefits as well as buying a home. That's awesome. But it's not just buying a home. Like your life is changing when you go through this process. So I'd say, you know, maybe not everyone has that mentality. I've always tried to, you know, treat everyone as a person and not just a loan number, if that makes sense.
And I'm like the exact same way when it comes to, you know, helping people buy a house. And I think that's why I've enjoyed working with you because you have pretty much the exact same mentality as me when it comes to this business. You know, is it a numbers game? Yes. Are we doing this for a career? Yes. But if we go out of our way to make sure something gets done right, you know, I've told you my stories. I've helped people paint. I've helped people. I've helped people mulch. I've helped people do yard work. I've helped people move.
Fences.
This coming up week, I could be helping, you know, my entire best friend move his entire house in a day because they're about to give birth the next day. You know, I've told you so many stories. So I think finding somebody that has my same mindset and goals and passion for this industry and like generally wants to help people, and it's not just I'm gonna make X amount off this person. It's refreshing, and that's what I'm gonna cry.
Amen.
Amen to that.
Amen.
But that's generally like why I enjoy working with you so much, and I think that's why everybody should work with Jackson. He's an amazing guy, really is.
Yeah, right back at you.
We kind of got into a bro sesh there, really hard. Let's go back. Okay, let's backtrack this a little bit. So, let's talk about: is there any certain? I don't want to say this. So, kind of getting into the pre-approval stuff, going back a little bit more to that. Is there any certain document that should be a document that a buyer kind of needs to get you? Is that the first document they need to provide to you? Is it like a W-2s? Like what should they be sending you, you know, to really start getting pre-approved?
So I think earlier I said we don't ask for blood samples or hair samples.
That's really about it.
We ask everything else.
You have everything else.
Not really. You know, if you're about to go through this process, I think you should create like a Google Drive or a folder on your laptop and put these things in there. 30 days of your most recent pay stubs. That's not 30 pay stubs. So like if you're paid bi-weekly, 2 pay stubs generally gets the job done. Your 2 most recent W-2s for any position that you've worked with. So 2024 W-2s and 2023 W-2s at the recording of this video. But if you worked at 3 different places in 2023, we need all 3 of those. If you're self-employed, we generally need all pages of your tax returns. You need 2 most recent bank statements. And then if you receive any overtime or bonus, the end of your pay stub that you got in 24 and 23, because unlike a W-2, it breaks down overtime and base. So pay stubs, bank statements, tax returns if applicable, and W-2s.
Gotcha. So kind of getting towards the end here. What is one question you wished buyers would ask you on the phone to make your life easier?
I think that when we go through the pre-approval consultation, I give my pros and cons, and sometimes I'll say, hey, if this was me, here's what I would do. But I think buyers should ask, Jackson, if you were in our shoes, what loan option would you go with? And this is outside of, you know, what I do for a living, but I research it a lot. I think having conversations with people about what they can do with their money outside of purchasing a home is something that I wish they would ask me about. If you have money just in a checking account or a savings account, you're losing to inflation. You can have a high yield savings account right now that gets you like 4.5% or 5% interest. Everyone should have one of those right now. I think everyone should have money in the stock market as well. And then after closing, I talk to my clients about this so they don't have to ask me about it, but 3 things that I believe you should do is you should look into getting a life insurance policy to cover the mortgage, at least if you were to pass away, especially if you have kids, especially if you have, you know, loved ones. You should look at putting the home in a trust. If you die and you don't have a trust, even if it's in your will, it goes through probate and you have to pay a lot more taxes on it. Whereas if it's in a trust, there's no taxes when it gets to your heirs. And paying down the mortgage faster, you know, making extra payments on your mortgage and how much money that saves you. Everyone should have a calculator, and if you have extra disposable income, you should put some of it towards paying down your mortgage faster.
Gotcha. Well, Jackson, I appreciate you coming out here today and answering all of our questions for you. Guys, thank you so much for tuning in to Rooted in Richmond. Make sure you like, subscribe, and I'll see you in the next video.